Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Intel stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Intel is a semiconductor chip designer and manufacturer. 20 plus years ago, Intel was the largest semiconductor by far, but I'll show you later they've fallen down on the list. The company is headquartered in Santa Clara, California, and was founded in 1968. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, Xetra, Vienna, Swiss, Colombia, Santiago, Brussels, Kazakhstan, Sao Paulo, Lima, Buenos Aires, Hong Kong, and Bulgaria Stock Exchange. Let's get started with the model. This is a large cap company, 121 billion market cap. They're trading at $29 a share, and they have 4.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see in 2020, they had a ton of free cash flow, $21 billion. It dropped in half to $10 billion in 2021. Now it's negative in 2022. I know they're investing a lot to grow their business. They're building out a lot of factories and growing their infrastructure. Hopefully that leads to greater free cash flow in the future. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's around $20 billion a year from 2019 to 2021. Then it drops a lot to $8 billion in 2022. Revenue is the sales for the company. That doesn't look so good. It peaked at $79 billion in 2021, then dropped a lot to $63 billion in 2022. They're losing a lot of market share, mostly to AMD. This is the company's income statement. The top line is the revenue, the sales, and you can see that one from $71 billion to $63 billion, highest in 2021. Here's a breakdown of their revenue in a little more detail. Of the $63 billion of revenue, $11 billion is from desktops, the semiconductor chips that go into desktops, $19 billion from notebooks, $2.3 billion from other. They also do a lot of business in data centers, $19 billion, network and edge, $9 billion, Mobileye, they acquired Mobileye, the revenue from that is $1.9 billion. I know they're trying to grow their foundry business, that was $900 million. Foundry is the opposite of fabless. Taiwan Semiconductor is the largest foundry in the world. Taiwan Semiconductor's entire business model is manufacturing semiconductor chips for other companies, like Nvidia. Intel does both. They're a fabless and a foundry. The nice thing about investing in Intel, they're not too concentrated in one country. They generate $16 billion of revenue from the US, $17 billion from China, $10 billion from Singapore, $8 billion from Taiwan, and $11 billion from the other regions. Their revenue went down a lot in China, from $23 billion to $17 billion. It also got cut in half in Singapore from 18 to 10, but it did go up in the United States. Let's go back to the income statement. Below the revenue is the cost of revenue. These are the expenses directly related to generating the revenue. The cost of manufacturing the semiconductor chips is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that's gone down a lot from $42 billion to $27 billion. Then you have operating expenses. R&D and marketing are operating expenses. Gross profit minus operating expenses gives you your operating income, and that's down a lot from $22 billion to $2 billion. They spent $500 million of interest on their debt, which is a lot lower than 2020 and 2021, a little higher than 2019. They spent $1 billion in financing costs. Other income and expenses are the gains or losses not part of the company's core operations. If they were to sell one of their subsidiaries and they made a profit, the profit would go to other income and expenses. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is their net income, which is down a lot in 2022, from $20 billion to $8 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash. because net income is your accounting profit or loss. It's not actual cash. Then you have CapEx, which are investments in property, plant, and equipment. They're spending a lot on CapEx to grow their business, $25 billion in 2022. Operating cash flow minus CapEx give you your free cash flow, and that was negative in 2022. So they had to add a lot of debt. They added $10.5 billion of debt, paid down $5.3 billion. So they increased their debt load $5 billion in 2022. They also added $1 billion of capital stock. When a company adds capital stock, that increases the shares outstanding. It makes your shares less valuable. But in prior years, they had enough cash flow to buy back stock. They bought back $13.5 billion of stock in 2019, $14 billion in 2020, and $2.5 billion in 2021. Hopefully 2023 they get back to generating lots of cash flow so they can buy back stock and pay a nice dividend. Let's look at the capital structure. $100 billion of equity, $42 billion of debt. They're 71% equity, 29% debt. Their net debt is $13.7 billion. So they do have a lot of cash on their balance sheet, about $30 billion of cash. I use the middle whack on Finbox, 12.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value to total cash flows past year 4, that's $148 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $129 billion. We divide that by 4.1 billion shares. And we get a calculated stock price of $31. They're trading at $29, so they're trading at a 6% discount. It's a buy according to the model. Their 2025 revenue estimate is $65 billion. 2024, it's $59 billion. And 2023, it's $51 billion. And I continued this trend into 2026, and I got $72 billion. That's how I got their future revenue estimates. They convert on average 21% of their revenue into free cash flow. So I multiplied their future revenue estimates by 21%. That's how I got their future free cash flows. So based off of my model, it looks like they're pretty much trading at intrinsic value. The website Simply Wall Street values the company at $28. They're saying it's 5.5% overvalued. 30 analysts priced this stock, and the average price target is 28, the low is 17, the high is 45. Another 33 analysts priced this stock, and their price target is 29.02. So they're saying it's trading pretty much at intrinsic value. This is where the stock has been trading the last 5 years, and you can see it's gotten murdered lately. It was up to $70 a share at the beginning of 2021, and then it fell down to $25. It might not have traded this low in over 25 years. In the past 5 years, this stock is down 41%, and the semiconductor ETF, which tracks the semiconductor industry, is up 145%. So this company is really doing poorly relative to its industry. The one bright spot is you do get your dividend payment. They pay a pretty good dividend, 5% yield, and they raise it every year. It was 30 cents in 2018, it's up to 37 cents. And the way you calculate the dividend yield, you take the last dividend payment, 37 cents, multiply by 4, that's $1.48. You take that number and divide by the stock price. That's how you get the annual dividend yield. Their payout ratio is 75%, but they have negative free cash flow, so we can't look at their dividend over free cash flow. This is their dividend yield the past 10 years. The forecast is for their yield to be 3.3% by 2025. They do have a low beta, so the stock is not too volatile. It's down 43% in the past 52 weeks, while the S&P is down 13%. The 52-week low is 25, the high is 53. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. 54 million shares are traded each day. Pretty much all the shares outstanding are on float. 64% are held by institutions, and 2% of the shares are shorted. They've done 6 stock splits, a 3-for-2 in 87, a 2-for-1 in 93, 95, 97, 99, and 2000. That was the heyday for this stock. Ever since 2000, the stock has not done so well. If you put $10,000 into this company 10 years ago, you'd be at $18,000 today. That's a 6% annual return. But if you sold the stock last year, you would have been up to $35,000. In the past year, there's pretty much only insider buying, very little selling, one small sell. So that's a bullish sign. So you can see every quarter in the past year, lots of buys, 28,000 shares, 100,000, 15,000, 11,000. 62% of the company is held by institutions, 38% by the general public, 6 basis points by insiders, and 4 basis points by the government. They do employ a lot of people, and their employee count is going up, which is a good sign. They have over 131,000 employees. Their biggest shareholder is Vanguard at 9%, then BlackRock 8%, State Street, Capital Research, and Geode. There are 62 companies in the same industry as Intel, and Intel used to be number 1 for a long time. They were the largest semiconductor company. Now they're number 7. Nvidia, 670 billion market cap. Taiwan Semiconductor, 500 billion. Broadcom, 3rd. Texas Instruments, AMD, Qualcomm, and then Intel. And if Intel has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a lot on CapEx. They're trying to grow their foundry business. That's why they spend so much in CapEx. Same thing with Taiwan Semiconductor. They do all the manufacturing. Nvidia is fabless. They don't really do much manufacturing. That's why their CapEx is low. Intel's debt to equity ratio is 0.4. That means for every dollar of equity, they have 40 cents of debt, better than average. They pay a nice dividend, highest on this list. They do have negative free cash flow. Their price to book is really good. It's 1.2, a really good PE of 15. We can't look at their price to free cash flow. They have negative free cash flow. They generate lots of revenue, more than anyone else relative to their market cap. For the longest time, they generated the most revenue, but now it looks like Taiwan Semiconductor is number 1 in revenue. But they're not growing. In the past 5 years, they're pretty much flat. And their ROA and ROE are better than average, but lower than most of these companies in the top 6. So to summarize, I have them trading at a 6% discount. And is this the bottom for Intel? Is this a good time to buy? It seems like it is. But I got hosed buying this stock. I did buy it last year. I sold it actually a couple of weeks ago. Not sure if I want to buy back in. They've been lagging for a couple of decades now. But I am hopeful that this company is going to turn it around. I just don't know how long it's going to take. I ranked their free cash flows 2 out of 10, their revenue 5 out of 10, and their ratios 8 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.